It's funny how easily we can get, fixated on the big headlines.
The ones screaming from every financial news outlet.
Exactly. But sometimes the really significant shifts are happening much more quietly, sort of under the radar.
Like Bitcoin hitting an all-time high.
Yeah, but in Argentina. Now, you might just shrug that off, right?
Sure.
But it kind of begs the question, could this be a warning shot? Maybe a sign of things to come for your currency?
It's like a global tremor that many people, especially if they're just glued to the mainstream news, might be completely missing.
Yeah, and what's fascinating is this apparent disconnect. Everyone's bracing for recession.
Right, that's the main story.
But then you hear these murmurs, these whispers of potentially, explosive resurgence in crypto, particularly Bitcoin.
It's about spotting those subtle signals, before they hit the big time, before it's mainstream.
Exactly. So in this deep dive, our goal is really to cut through all that noise. We're going to try and dissect the crucial factors that could be fueling this potential upswing.
And focus on what the smart money seems to be doing right now.
Right. And our exploration today, it's largely based on the insights shared in a recent YouTube video transcript from Lark Davis.
Okay,
So let's dive in. First up, something that maybe doesn't get enough attention. Liquidity.
right, liquidity. Think of it as the lifeblood of the financial system.
The grease in the wheels.
Yeah, basically. It's how easily assets can be bought and sold without causing wild price swings. Now, many focus on M2 money supply.
Sure. That's the common one.
But Arthur Hayes, the CEO of BitMEX, he highlighted another really insightful indicator, the Muvani Index.
Ah, the Muvani Index. That's the U.S. Treasury volatility tracker, isn't it?
That's the one.
So it's like a measure of expected bumps in the road for bonds, how much turbulence the Fed might be anticipating.
Exactly. And it potentially signals when the Fed might need to step in and, ease things.
Okay, so what's it telling us now or recently?
Well, historically, an MUV index reading above 140, that's often preceded periods of financial stress.
Okay, 140 is the magic number.
Kind of a critical level, yeah. And back on April 9th, it actually spiked really close to that, hit 139.88.
Wow, okay. So almost knocking on the door.
Very close. And that proximity, to previous crisis levels, it suggests that smart money likely saw this as a flashing yellow light.
A signal to maybe get ready for.
Yeah.
Fed action.
Potentially positioning themselves for Fed intervention, exactly.
But here's where it gets really interesting, right? It seems the Fed might be sort of subtly adding liquidity already. Without, big QE announcement banner.
Precisely. While the market's been kind of waiting for that formal QE announcement, the Treasury, they've already started buying back some of their older, less liquid bonds.
Ah, okay. So swapping old debt for new cash in the system.
Effectively, yeah. They're not calling it QE, but functionally, it achieves a similar outcome and injects reserves into the banking system.
It's, as some might say.
Kind of quantitative easing in everything but name.
Right. Stealth liquidity.
You could call it that.
And the key insight here, the connection, is that riskier assets, like Bitcoin, they tend to like this, right? When liquidity increases.
Absolutely. It's generally seen as a bullish sign for risk assets.
So more money flowing around looking for a home, potentially in crypto.
And if we look back historically, increases in M2 money supply, they've tended to precede Bitcoin price increases by roughly 3 months.
Okay, a 3-month lag, typically.
Typically. So if that pattern holds and we're seeing this, let's call it quiet uptick in liquidity now,
It could point to a crypto pump coming.
it could very well point to a sustained uptrend for crypto in the coming months.
Yeah.
It's a reminder, not to get so tunnel visioned on recession fears that you miss these crucial liquidity shifts.
Good point. Okay, so we're seeing this potential increase in liquidity.
Right.
But it's not just about these big macro indicators, is it?
No, not at all.
There are also some pretty compelling signals coming directly from the crypto market itself, especially around institutions.
That's a critical layer here. The inflows into the new Bitcoin ETFs, they've been substantial, really substantial.
We have some numbers. What are we talking about?
Okay, so get this. They absorbed a staggering $2.7 billion in a single week.
Wow. Billion with a B.
Yep, and then another $591 million just on April 28th alone.
Okay, that's serious money flowing in consistently.
That kind of sustained demand strongly suggests institutional accumulation. Big players are buying.
Which is just a fascinating contrast, isn't it? Compared to what some individual investors might be doing.
How so?
Well, maybe panic selling amidst all the broader economic uncertainty. It's almost like Wall Street's on a buying spree while Main Street might be, heading for the exits.
That's a really interesting dynamic, and another indicator that feeds into this is Tether.
Right, the big stablecoin.
USDT.
The biggest U.S. dollar stablecoin, yeah.
Yeah.
Its market cap has reached a new all-time high, $145.6 billion.
Huge number.
And over $8.5 billion of that was added just this year in 2025. Okay, so on the surface, that just sounds like more cash sitting on the sidelines, right?
Yeah.
Waiting.
It might seem that way. But here's the nuance. Like you said earlier, it's not just the total amount of Tether.
It's about its dominance, its market share.
Exactly. Its dominance relative to the total crypto market cap is actually declining.
Ah, okay. Explain why that's significant.
Because it suggests that investors aren't just holding stablecoins as a safe haven. They're feeling confident enough to actually deploy that capital.
When we get out of stablecoins.
And into riskier assets, like Bitcoin. It indicates a shift in sentiment, a growing risk appetite.
Gotcha. Less money parked, more money moving.
Precisely. And historically, these periods, falling Tether dominance alongside a rising Tether market cap, they've often preceded significant upward moves in Bitcoin's price.
Okay, another historical pattern suggesting potential upside. So the money's actively moving into the market, key distinction.
Mm-hmm.
And it's not just where the money is flowing. The price charts themselves, the technicals, are starting to look better for Bitcoin too.
They are, yeah. Across various timeframes, Bitcoin is showing some positive technical signals.
Like what?
Well, it broke above a recent downtrend, and importantly, it's reclaimed both the 21-week and the 50-week exponential moving averages, the EMAs.
Okay, reclaiming moving averages. Why are those seen as like classic bull market signals by analysts?
Think of these averages as representing the sort of baseline price trend over those periods. When the price dips below and then decisively moves back above them.
It shows strength, buyers stepping in.
Exactly. It suggests buying pressure is overcoming selling pressure, and that the longer-term uptrend is likely resuming.
Is there a recent example of that?
Yeah, remember when Bitcoin briefly dipped below the 50-week EMA after the news about Trump's tariffs?
Vaguely, yeah.
It didn't stay below for long. It bounced back pretty quickly. That rapid recovery indicated underlying strength. Buyers were willing to step in and support the price.
Right, a sign of resilience. And even with some recent sideways chop, Bitcoin's price has held relatively steady around that $94,000 level.
Yeah, it's been consolidating there, though obviously things can change fast in crypto.
Always the caveat. But the point is, these periods of consolidation, especially near strong resistance levels, they often precede what?
Significant breakouts. Potentially violent ones, even.
Okay.
And keep an eye on Bitcoin's first closing price of 2025. A decisive break above that could be a big psychological trigger.
Getting above the year's opening price.
Right. It could fuel more buying. But of course, you want to see those levels then hold as support to confirm the move. Retesting is key.
Always. And it's not just the longer-term charts, right? You mentioned shorter-term indicators are flashing positive too.
Absolutely. The 3-day MACD, for instance.
Okay, the MACD. That looks at momentum.
Yeah, it helps traders spot short-term shifts in momentum by comparing different moving averages. And it recently flipped bullish.
Meaning the shorter average crossed above the longer one.
Exactly. Another classic signal that a new uptrend might be gathering steam.
And you mentioned a historical example of this specific signal.
Yes, the last time we saw this bullish crossover on the 3-day MACD was back in October 2024.
And what happened next?
Well, Bitcoin's price surged. Went up by an impressive 88% over the next 3 months.
Wow, 88%. Okay, so that highlights the potential predictive power sometimes of these shorter-term signals.
It can, yeah. It shows they can sometimes identify the start of pretty significant moves.
Okay, so let's piece this together. We've got increasing liquidity, maybe stealth liquidity, strong institutional demand shown by the ETF flows.
Billions flowing in.
Capital rotating out of stablecoins like Tether, suggesting growing risk appetite.
That dominance falling.
And bullish signals flashing on both long-term and short-term charts.
Reclaiming key MAs, MACD flipping.
Yet, there's still this sense of caution out there, isn't there? And you can understand why, because the broader macro environment seems, well, a bit shaky.
That apparent contradiction is exactly what's causing some hesitation for investors. It feels weird, right?
Yeah. Crypto seems to be heating up while the economy looks like it could be melting down.
But if we connect this back to the bigger picture, some interesting dynamics emerge. Take the US dollar index, the DXY.
Okay, what about it?
It's actually in a bearish downtrend, down 8% year to date.
which is interesting given some political figures have explicitly called for a weaker